Hi, my name is Jason Mellum, and I'm part of the Mellum-Mori team here at Lawyers Title. My team and I pride ourselves on knowing the current real estate market, and in 2019, we saw a huge uptick in absentee sales. And because of that, we're going to talk about 1031 exchanges. 1031 exchanges have been around since the mid-90s, but have recently become much more popular with investors who want to defer their tax on capital gains to some point in the future. This plays a big role for those who own multiple properties, such as vacation homes or rental properties, in addition to their own home. Section 1031 of the Internal Revenue Code provides that no gain or loss shall be recognized on the exchange of property held for productive use in trade or business or for investment. A tax-deferred exchange is a method by which a property owner trades one or more relinquished properties for one or more replacement properties of like kind, while deferring the payment of federal income tax and some state taxes on the transaction. Think of a 1031 as a like-kind exchange of one property for another. The theory behind a 1031 is that when a property owner has reinvested the sale proceeds into another property, the economic gain has not been realized in a way that generates funds to pay any tax. In other words, the taxpayer's investment is still the same, only the form has changed. For example, trading a home for a condo. Although most swaps are taxable sales, if your property meets the requirements of Section 1031, you may pay little or no taxes at time of exchange. Any proceeds are still taxable from the sale of your property, and that's why they must be transferred to a qualified intermediary. A qualified intermediary is a person or company that agrees to facilitate the 1031 exchange by holding the involved funds in the transaction until they can be transferred to the seller of the replacement property. If anything I have said has sparked an interest for you to reinvest some of the other properties you may own, keep the following in mind. The property must have been owned for a year. The replacement property must be identified within 45 days and purchased in 180. If you are doing a 1031 exchange to live in the property after the exchange, the property must be rented for 1 year before you move into it. Hopefully this information has been helpful. If you have any questions about this topic, please feel free to reach out to myself or anyone here at Lawyers Title. We're always happy to help. Thanks and have a great day. This comes into like vacation homes or other rental income properties. It's like, I'm just gonna start from the top.